Hi folks, Scott here, and this is the wrap for Friday, September 19th. So the market's still live here. I've got a webinar, educational webinar for our members and non-members in about 40 minutes. I'm going to hustle through this, but you may see the chart still moving. What I thought would be interesting would be to show you the results of fading gaps after you put in at least a 20-day high in one of the two prior days and on options expiration Friday. Let me say that differently. Fading gaps on option expiration Friday after putting in a 20-day high in one of the two prior days. Today actually ticked higher by a couple of ticks. So I wanted to increase the sample size so they were basically the same and just look at a 20-day high or higher in the past 2 days. And this will be conducted using Gap Trader, my backtesting application that is available for members and non-members on our website if interested. In fact, we're doing a live demonstration next week of this particular application, Gap Trader, MTG Gap Trader, along with MTG Range Trader. So be sure to sign up on our homepage if interested. So there you go. Odds look good using an end-of-day stop. Now, key is I don't use end-of-day stops, but it's a good place to start your analysis. And we see two things actually. At least a 2-to-1 odds of gapping up tomorrow on OpEx Friday after such a bullish occurrence as a new 20-day high. And using an end-of-the-day stop, it shows some really strong numbers. A gap down looks to be a little bit weak. Now, the key will be how these numbers look using a reasonable size stop, which we call our MTG stop parameters. Reasonable to us is equal to 30% of the 5-day average true range with a minimum of 5 points in the ES. So, and it varies by for the other indices, both ETFs and futures, of course. That's equivalent to about 50 cents for us, you spider traders. So, it certainly looks like odds favor a gap up and possibly a decent setup. All right, let me show you what the data showed this morning. Actually, it showed last night. Our worksheet is posted around 6 o'clock each night, along with the guides. The worksheet summarizes the individual gap guides. So at a glance, you can know whether or not it's a reasonable setup. Today, we were clearly opening above the highs in some of the indices and between the high and the close in the other. I think the Russell and the Dow were a little weaker acting. They were opening between their highs and close of yesterday, which was an even better setup historically, while the NASDAQ and the S&P were gapping in slightly less attractive setup and above the highs. But these are strong numbers. PF is profit factor. It's a ratio of profits, historical profits to losses, or said differently, for every dollar you've lost, how much you've made, and you made $1.50 for every dollar you've ever lost. So that's good. In fact, generally I'm looking for at least a 30%, 1.3 profit factor, or roughly knowing that it's made at least 30% more profits and losses. So clearly met my criteria here. And actually, correction, the ES opened one tick inside of yesterday's highs. It was banging around between the two. And that did impact me a little bit. Had it opened a little bit higher, I would have held some for the extended target today, because these two numbers here were greater than 80%. This just shows the odds of the extended target when compared to the odds for gap fill. If it's at least 80%, it generally makes more money. And that's just from experience with the way the math works out. Today didn't quite meet my extended target odds, so I did not go for it. So technically we did open. I misspoke, in this zone. That showed really good data. Now, other considerations, it was up gap day after Fed day during bullish markets. It's been neutral to maybe a little bit weak. Up gap on Thursday of OpEx week during bullish markets, real strong numbers there. Up gap after a widespread 7-day, that's a Toby Crable term, during bullish markets, real strong numbers there also. In fact, let me just show you the guide super quickly. So this is what I was considering today. These two scenarios, the weighted average between the UH zone and the UHC zone. And we end up opening a 1723 in the ES. So technically, this data here, which is just off the chart good, was set up. Now, what's interesting is that what made this so attractive was the market conditions. Sometimes this zone is these zones are not nearly as attractive, but current market condition, as I've described it here, strongly favored the setup. YM showed didn't quite meet my criteria, but very close. Good win rate. NASDAQ did, even though it opened above the highs. And then the Russell showed really strong numbers in the UHC zone. Looking at the ETFs, You know what? I think I'm misspoke again. The Russell was UHC zone also. Sorry. I only traded the ES, so sometimes I get these confused and I'm going a little bit too fast here. Looking at the ETFs, SPIDA confirmed the setup just like you hope it would. It would for the ES. Diamonds looked good. Qs all looked good, and Russell. So everything, both zones for both markets looked really good. So my comments here. A couple other considerations I posted last night. Fed day, following Fed day after closing up at least 0.5% when above the 200-day moving average is actually a little bit risky. It's a small sample size, but you hate seeing numbers this lopsided. And that tells me when it's really not supported by anything else, it's very day specific, so the day after Fed day. And that meant we're maybe more prone to getting some volatility after the open. Just looking specifically at closing 0.75% higher and at least a 20-day high close when above the 200. Really strong numbers there. Betting large gaps in general in the UH zone above the 10 and 200-day moving average, a little bit of a concern. This is discounted by the fact that our guides showed really good numbers for the UH zone, and most of the time gaps in the UH zone are indeed large. So, but I thought it was worth pointing out so people wouldn't bet the proverbial farm. So bottom line, as I said, the guides are showing positive overall setups. By the way, if I say positive or attractive, that's one and the same. Sometimes I use different choices of words there. Unique pattern data showed mixed factors for fading up gaps at the open because of these two weaker numbers here that I showed. And large gap post-Fed volatility, my biggest concern. So as long as we opened, well, actually, if we opened below 17.23 and a quarter, it'd be in the UHC zone. I'd use 3/4 position size, which is basically a full position size. Just discounted a little bit for potential post-Fed volatility. And if the ES opens higher, you enter 1/4 of the open and 1/4 on a delayed entry. The key concern there is that this UH zone can sometimes run against you 6 or 7 points, and I've seen it happen where you just have people completely surprised by a major news announcement like a Fed announcement, and they're forced on a big gap up to cover. And you just got to survive the initial thrust, the initial move, and then after that you're in pretty good shape. So that was just simply trying to, plus you tend to have a little bit more volatility, so trying to get a little bit bigger average win size on half of that trade while reducing my risk as well. But as it turned out, we opened 17.23 exactly, so I went short, had the open 3/4 position size, and took no heat. It just started filling right away. It was a beautiful thing for about a 5-point win. I scaled out a little bit, but I was filled at 16.22.75. I had a ticket slippage today. So just shy of a 5-point win. And that was the only trade I did. The 15-minute NOR, the first hour range trades, looked particularly good to me. So I just, if you pardon the expression, counted my money and focused on some research and called it a day. So there you go. That is the wrap for Thursday, September 19th. Have a good one.